Hello and welcome to another video on US taxation. So till last video, we have explained that how the income which is being earned by the freelancers, gig workers, consultants, and self-employed people, how that income needs to be reported through various mechanisms. Now, from this chapter, we are going to talk about how the income from the capital gain is being reported, how the capital gains are calculated, how the losses are calculated, what is the concept of short-term and long-term capital gain, concept of carry forward of the losses, and then the period in which the losses are carried forward, and then how these losses impact the overall income. And finally, how these information is getting reported through various schedules and finally integrated with Form 10 also. We'll talk about all of this and much more in this chapter. So let's start this chapter by looking at the agenda. Okay. So what we're going to cover in this chapter, we are going to touch base upon the concept of Schedule D, which is the major schedule for capital gains. We'll understand the concept of the capital asset and we'll quickly walk us through the schedule to a deep overview. We'll also understand the integration of Form 8949 form, which is the major form for Schedule D. We'll understand the various parts of Schedule D, which is Part 1, Part 2, Part 3, and we'll understand how the information is being inserted in these forms, this form, and then how that information is finally linked with Form 1040. We'll understand the concept of cost basis determination and two important concept of wash sales rules and the pass-through entities. We'll also understand the capital loss limitation rule because the losses which is being incurred where my sale price is less than the cost basis, then there is a loss, and then what are the rules for carry forward of those losses. We'll understand the integration of Schedule D with other form, and then we'll quickly apply all these logics and understand this entire concept through the practical case studies, and we'll summarize these chapter with the key takeaways. So let's move to the first slide and understand the introduction to Schedule D. So now we are going to talk about the Schedule D. So introduction to Schedule D. So Schedule D is used to report the capital gain and the capital losses. So this is the schedule which helps to evaluate the total capital gain or the loss that has been incurred during the particular tax year, and resulting from the sale or exchange of the capital asset. So basically, any capital asset which is being disposed of that results into the capital gain or the capital loss depending upon the price at which it has been sold. It is one of the most important schedule for the taxpayer involved in the stock investing, mutual funds, ETF, bonds, real estate investment, cryptocurrency transactions, and the other investment assets. Schedule D helps to determine the taxable capital gain, deductible capital losses, applicable capital gain tax rates, and the net investment results too, which finally flows into the Form 1040. What is capital gain? So capital gain occurs when an asset is sold for more than its cost basis. This is simple. And likewise, what is the capital loss? The capital loss occurs when the asset is sold less than the cost basis. Common assets which are reported in Schedule D are the stocks, ETF, mutual funds, bonds, cryptocurrency, investment in real estate, and the other investments. And this is the most important schedule to highlight the capital gain, which receives a special treatment because it has a special and preferential rate. Unlike ordinary income, so long-term capital gains may qualify for the preferential rate and the lower tax burden. So typically, two category of capital gain are there, which is short-term. Short-term is 1 year or less. If the holding period of the asset is 1 year or less, the tax treatment is taxed as the ordinary income tax rate. But for the long-term capital gain, which is if the asset is held more than 1 year, then the tax treatment is the preferential tax rate applies, and we'll talk about this in the upcoming slides. So part 1 of the schedule D is the short-term capital gain and losses. Part 2 is long-term capital gain and the losses, and part 3 is the net gain or the loss. So these are the 3 parts, and we are going to discuss about these 3 parts in detail, line by line, in the upcoming slides. Integration with the Form 8949 investments transactions are first reported on the Form 8949. So this is the form wherein All the investment transactions are first reported. Form 8949 purposes reports individual sales transaction, cost plus information, gain or loss calculation, and the information from Form 8949 flows into Schedule D, and from Schedule D it flows into Form 1040. So Schedule D is ultimately impacts the taxable income, capital gain tax calculation, and if I have to look, if we have to look at the entire flow, so information in Schedule D comes from Form 8949, and information from Schedule D moves into Form 1040. Schedule D is the gateway of the capital gain transaction, where whether the taxpayer invests in the stocks or the mutual funds, ETF or the real estate or the cryptocurrency. Understanding how gain or losses flow through the Schedule D is essential to accurate reporting, tax planning, maximizing, and after tax investment returns as well. So we'll move to the next slide and see what is it that Schedule D has, and we'll look at the entire schedule. Okay, so before moving to have the overview on the Schedule D and have a holistic look at that how that Schedule D actually looks, let's spend some time and understand the concept of the capital asset in context to the capital gains. So before understanding Schedule D, it is essential to understand the concept of the capital assets. A capital asset is generally any property owned by the taxpayer for investment purpose, personal purpose, wealth creation, and the appreciation. So typically, a person holds a capital asset because they want to get the gain from the disposal of the asset, and the value gains over the period of the time. So the purpose of holding the asset is for the investment purpose. It can be for wealth creation as well as for the personal purposes. So sale or the exchange of the capital asset may result in the capital gain or capital loss, which must be reported through Form 8949 and Schedule D. Under the Internal Revenue Code, a capital asset generally includes a property owned by a taxpayer, investment held by appreciation, personal use asset, and a securities and financial instrument. Common example of capital assets are stocks, ETF, mutual fund, bonds, cryptocurrency, real estate, precious metal, and the personal property. Capital asset categories, so we'll talk about it. Investment assets purchased primarily for the appreciation and the income generation. Real estate is also a capital asset if it is held for the investment purposes and the personal purposes. Common capital assets, real estates are investment property, rental property, vacant land held for the investment. Real estate may involve depreciation adjustments. So basically, depreciation adjustments are being handled separately through the Section 1250 rules. And then cryptocurrency is also a capital asset. So IRS generally treat cryptocurrency as the property. Taxable event for these is the sale for the cash, cryptocurrency to cryptocurrency exchange, or use of the crypto to purchase of the goods and services. So these are like taxable event basis which we could able to establish whether the asset has been transferred or sold. Assets that are not capital assets. There are certain of the assets which are not capital assets. So basically, if the taxpayer is using the particular goods as an inventory, then it's ordinary business asset. Accounts receivable is a business income for the business income item, and then like business supplies and operating assets, and like depreciable business assets, the separate tax rule applies. So for depreciable assets, a separate tax rule applies, but these are still the capital assets. But the real purpose for capital gain is to evaluate whether the asset is being held for the investment purposes or for the appreciation or for the wealth creation. Most important concept is that the holding period matters. If an asset is being held for less than 1 year, then 1 year or less, then short-term capital gain applies. But if it is more than 1 year, then it is a long-term capital gain. So capital asset purchase, sale of the asset, Form 18949, Schedule D, and Form 1040. So capital asset form the backbone of the Schedule D reporting. Before calculating the gains or losses, the tax rates, the taxes the taxpayer must file first determine whether the property sold qualifies as a capital asset. And if it is a capital asset, then the next important concept is to evaluate whether the asset is being held for less than or one or equal to 1 year, or if it is held more than 1 year, because the treatment of the capital asset and the tax is depends upon the whether the asset is the short term or the long term. So now we have understood the concept of the capital asset. We are in a position to understand an overview, the form, the Schedule D. Then we'll move to the next slide and have a look at the Schedule D holistic. Okay, so this is the overview of Schedule D, wherein we already mentioned that it has three parts. So part one is short-term capital gain and the losses. which is being report total from the 8949 part 1, include the short-term transaction, calculate short-term capital gain or loss, net short-term capital gain or losses carried to the part 3. Part 2 is long-term capitalized gains in the losses assets while more than 1 year. So report total from the 8949 part 2 includes long-term capital transaction, calculates the long-term capital gain, and information is net information flows into the part 3. And the part 3 is the summary and the total of the capital gain and loss. So combine net short term and the long term results determine the overall net capital gain or the net capital loss. If net capital loss is up to 3,000 or 300 gain of the merit finding singly can be set off in the ordinary income. Remaining loss will carry forward to the future year and the final amount is transferred to form 1040. So if you look at the flow, 8949 is the main form, report individual transaction, schedule D calculate the net short-term gain and the long-term losses. Part 3 is the summary and the analysis summary flows into the form 1040. So this helps us to understand the entire form D pictorially, and then also what is the flow of the information from 8949 form to schedule D and then finally to form 1040. Now we'll move to the deep dive of each of the section. Okay, so before we'll move to the deep dive on each of the part of the Schedule D, let's just spend some time in understanding the major form, which is 8949 form. So form 8949 is the detailed transaction report from use to report, individual capital asset sales and the exchange. It serves as a supporting schedule for the Schedule D. So purpose of 8949 is to capture the date acquired, date sold, sales proceed, cost basis, adjustment, capital gain losses, etc. And then form 8949 is equal to detailed transaction reporting. Schedule D is the summary report. Sale of the stock ETF cryptocurrency assets is being reported in form 1019B. From it is 1019B. It moves to 8949 and then it moves to Schedule D and finally to 1040. So why Form 8949 exists? So before Schedule D can summarize the gain and losses, taxpayer must report every taxable transaction, cost basis information, and adjustment required in the IRS. So typically, if we have to break the entire understanding, like what is the difference between the Form Schedule D and the Form 8949? So 8949 is typically the detailed transactional form, while Schedule D is the summary form, which helps to assimilate all the transactions which are reported in Form 8949, and then it has to report the transaction into the two major block, which is like short term and the long term, and then final part 3, which speaks about the entire net capital gain, profit or loss, gain or loss for for that particular financial year. So form 1099B integration. So most taxpayers receive form 1099B from the brokerage firm because these firms are taking care of all the investments in the firm stocks and the mutual funds. For some common brokers are Fidelity, Charles Schwab, Vanguard, Robinhood, E-Trade, etc. Information from 1099B to 8949 and finally it moves to Schedule D. So think of 8949 as a detailed ledger of the investment transaction and Schedule D as executive summary. Every stock sale, ETF transaction, mutual fund redemption, cryptocurrency disposal is being starts from 8949 before flowing into Schedule D and ultimately affecting taxpayer overall tax liability. Now we are in a position to understand the detailed of Schedule D. So we'll move to the next slide and see the deep dive on each of the Schedule D parts. Okay, now we'll talk about the Schedule D part 1 line by line deep dive. So, purpose of Schedule D Part 1 is to use to report the short-term capital gain and the losses. Common assets reported as stock, ETF, mutual funds, cryptocurrency, investment property, with holding period equal to or less than a year. Short-term capital gains are taxed at the ordinary tax rate, and unlike long-term capital gain, there is no preferential tax that applies. So, if you look at the sections, so line 1A to 1C is the summary transaction of 8949. Lines 2 to 3 is the additional short-term capital gain or loss reporting. Line 4 to 6 is the partnership trust and the pass-through gains and losses. And line 7 is the net short-term gain or the losses. So line 1A reported transaction, no adjustment required. So basically purpose is report short-term transaction where cost basis report to IRS, no adjustment required. Typically basically from form 1099B. Line 1B and 1C transaction required from 8949. Line 1B is used when the process reported to IRS adjustment required. Example, there are some wash sales, basis corrections, corporate corrections. All this is being reported via 8949, but the base of this information is 1099B. We'll talk about washes, what is washes in the upcoming slides. Line 1C is used when the basis not reported to the IRS. Example like older securities, certain private instruments which is being not being reported in 1099B. So line 2 and 3 is other short-term transaction used to report the additional short-term gains, transactions not otherwise reported through 1099B. Common sources are special investment transactions, certain investment sales, miscellaneous capital asset sales. Line 4 to 6 is like pass-through entries, typically from the pass-through entries or the entities that actually are not subject to the tax, like partnership, S corporations, trust, because the income from the partnership is being liable to be taxed in the hand of the partner, and hence all the information flows into the hand of the partner, which needs to be reported in the Schedule D. We'll talk about the concept of pass-through entities in the upcoming slides. Line 7 is the net short-term gain of the loss, and most important line is part 1 is line 7 summarizes all the gains or loss for all the adjustments. Formula is net gain minus net losses. Tax impact is that short-term capital gains are normally taxed as the ordinary income, and after line 7 is calculated, it flows into the part 1 net gain or loss. It flows into the part 3 summary, which is being combined with the part 2 to report the final amount of the capital gain for that particular financial year. So part one of Schedule D focuses exclusively on the asset held for 1 year or less, because these gains are taxed as the ordinary income tax. Understanding the holding period basis reporting and the 8949 integration is essential for accurate tax reporting in the effective investment tax law. We'll move to the next slide and look at the part 2. Okay, now we'll talk about the part 2. So, as we understood that part 2 is largely for the long-term capital gains and the losses, which is held for more than 1 year. So, why part 2 is important? So, unlike short-term gains, long-term capital gains are qualified for 0% tax rate, 15% tax rate, 20% tax rate, depending upon the taxable income. Common assets are long-term transactions from and then long-term capital gain and losses. And common investments, common assets are again mutual funds, cryptocurrency investment in real estate, business investment, assets, etc. Structure of Schedule D part 2 is like 8A is long-term transaction, no adjustment required. Again reported through 1099B. Line 8B and 8C is used when the basis report IRS adjustments are required. Then we have the boss adjustments, basis corrections, and the corporate reorganization. So all this is being reported via 1099B. As I mentioned that we'll talk about the concept of watch sale transactions and watch adjustment in the upcoming slides. Line 8C is used when the basis not reported in the IRS. Basically, again, the certain inherited asset, older security, which is not being reported via 1099B. Line 9 and 11 is gain and losses from the other sources. So these lines capture the gain and losses reported from installment sale, certain involuntary conversions, other IRS required capital sources, capital reporting sources. Purpose is to ensure that all long-term capital transactions are included. Then we have line 12 to 14, which again speaks about the pass-through capital assets, pass-through entities. We'll talk about again in detail about pass-through entities. And then line 15 is the net long-term gain or the loss, most important line in the part 2, because the information from line 15 flows into the part 3. So we have the information from part 1, which flows into part 3, information from part 2, which flows into part 3, wherein the total losses are being calculated. Losses or gains are calculated. So Schedule D part 2 line 15, part 3 summary section combined with the part 1 results and the net capital asset. Reporting flow is 8949, Schedule D part 2, Schedule D part 3, and Form 10. So part of Schedule D is an important and many of is valuable for benefit of US taxation systems as realized by holding the investment for more than 1 year, because this is a place wherein all the information needs to be reported and summarized. And that summarized information is finally flows into the part 3. We'll move to the next slide and look at the part 3. So we are in the last leg of Schedule D, which is like part 3. So we'll talk about the part 3 of the Schedule D. So part 3, if you look at it, is the purpose is that Schedule D part 3 is the final summary section. So it combines the net short-term capital gain or loss and the net long-term capital gain and loss, which is reporting in the part 1 and the part 2. Objective is to determine the taxpayer final net capital gain or the final net capital loss that will flow from 10 to Form 1040. So position of the part 3 in the tax law is basically information from 8919, 8949 flows into Schedule D part 1. We calculate the short-term capital gain and the losses. Then we move to the Schedule D Part 2. We calculate the long-term capital gain and losses. Then finally, we move to the Schedule D Part 3, and netting of the reporting is finally being computed into Form 1040. So Part 3 is the decision engine. It determines the gain or loss, tax treatment, and the capital gain loss limitation. Line 16 is the net short-term capital gain or loss. Line 17 is the net long-term capital gain or loss. Line 18 is the netting process. The IRS requires taxpayers to combine the short-term result and the long-term results to derive at the netting amount. The capital loss carry forward rules, unused losses. The carry forward indefinitely retains short-term or the long-term character used in the future years. Qualified for the capital gain tax treatment. If taxpayer has a net long-term capital gain, Part 3 determines whether it flows to the Form 10. So basically, if it is Part 3 determines whether which rate will be applied, whether it's 0%, 15%, or 20%. But if taxpayer has a net short-term capital gain, then definitely it would be taxed at the normal income tax rate. Flow to Form 1010. After completion, final result transfer to the Form 1040. Possible outcome can be net capital gain, net capital loss, or the capital loss carry forward. So Part 3 is where all the capital transactions come together. This section determines whether the taxpayer ends up with the taxable capital gain, a deductible capital loss, or a carry forward or a future year. Understanding netting process and the capital loss limitation rule is critical for the accurate tax reporting. So we'll move to the next slide. Okay, now we'll understand the concept of the cost basis. So one of the most important concepts in Schedule D in the Form 8949 is the cost basis. Cost basis is determination of the capital gain, capital loss, tax liability accuracy, because that is the most important element to understand the price that will be deducted from the sale value or sale consideration to determine the value of the capital gain or the capital loss. What is the cost basis? The definition is cost basis represents the taxpayer's investment in an asset. In simple term, it is usually the purchase price plus certain additional costs like brokerage or the incentive that is being given to purchase that particular asset. For example, stocks, ETF, mutual funds, bonds, cryptocurrency investment, and real estate. Example of acquisition cost is the brokerage commissions, transaction fees, settlement charges, and certain closing costs. We have the concept of adjusted cost basis. Cost basis may changes over the time. So adjustment that increases the reinvested dividend, capital improvement, additional investments. All these are the elements which is being added to the cost to derive at the adjusted cost basis. And then adjustment that decrease the cash basis return on the capital distribution, certain depreciation reduction, and the prior period adjustments. The real estate basis includes the purchase price plus closing costs or the capital improvement. When we talk about the cost basis in the cryptocurrency, so it includes the purchase price plus exchange fees plus the transaction cost. When multiple lots are purchased in IRS, it has several methods like FIFO method is used, specific identification method is used, or average cost method is used to identify or to evaluate the total cost for that particular asset. Brokerage often reports at the sale proceeds cost basis to both the taxpayer and the IRS. And the source document, as we understood in the previous slides as well, is 1099B, which is being issued by the broker, which contains all this information. And from that information flows into the 8949 form, and from 8949 it flows into the Part 1, Part 2 of the Schedule D. Every capital gain or loss calculation starts with the cost basis, whether dealing with the stocks, ETF, cryptocurrency, or the real estate. Accurate basis determines the essential tax compliances, tax planning, and the avoiding the IRS adjustments. So cost basis once determined, that will help us to establish the price that will be reduced from the sale consideration to arrive at the final capital gain or the capital loss. We'll move to the next slide. Okay, so now in the discussions we had come across two things very oftenly, which is like wash sales, and then second is the pass-through entity. So we'll talk about the wash sales first. So wash sales is one of the most important and the frequently misunderstood rules in the capital gain taxation. The rule prevents a taxpayer from selling an investment at a loss and immediately repurchasing the same or substantially identical investment solely to generate the tax deductions. So typically it's a period of 30 days. The period before sales is 30 days, sale date is 1 day, and after sale is 30 days. So what does this mean? So what is wash sale? So wash sale occurs when a taxpayer sells an investment at a loss and purchases a substantially identical security within 30 days before or 30 days after the sale. The total wash sale window is equal to 61 days window, which means that before 30 days or after 30 days, if somebody purchases a security which was which was intended to be sold at a loss in the future date after 30 days purchase, or if it has been sold sold and then it has been repurchased in 30 days, that is again treated as the loss transaction. So immediately impact is that loss is not deductible in the current year, which means that if somebody has purchased a stock at $100, sold that stock at $80, and then repurchased that stock at $120. So then, or let's say again purchase the stock at $100, then the loss of 20, which is there, it would not be available for the deduction in the current year. But what will happen? So the important is that the loss is not permanently lost. The disallowed loss is added to the repurchase cost of the replacement shares. So whenever replaced shares are purchased, it is the loss is added to the cost element so that the taxpayer will have the inflated cost. So what is substantially identical? The IRS does not provide a complete definition of what is substantially identical. Generally considered identical as same stock, same mutual fund, same portion contract or same bond. So investment type is stocks, ETF, mutual funds, option bonds. These are subject to the Washer's rule and cryptocurrency as well. Currently, generally not subject to under the current federal rules. This is as of now is not subject to the current federal rules, but it was there earlier. Transactions related to washers. So multiple accounts considerations. Washers rules applies to the brokerage accounts, joint accounts, IRA accounts. So Form 8949 reports the washers was reported in Form 8949. Reporting includes original loss, washer adjustment, adjustment code, adjustment gain or loss. So that all the information from 8949 flows into Schedule D, and from here it flows to the Form 1020. Washers rules are one of the most common causes of discrepancies between the taxpayer calculation and the brokerage. So understanding 61 days sales washers window basis adjustments and 8949 reporting is essential to accurate Schedule D preparation and the effective investment tax plan. Now we'll move to the next slide and see the concept of the pass-through entities. Okay, so pass-through entities. So a significant number of the taxpayer receives a capital gain and losses directly to the investment in partnership, S corporations, trust estates rather than reporting individual assets themselves. These are known as the pass-through entities. So typically, because income gain and loss reduction and credit pass through to the owners or the beneficiaries. What is the pass-through entity? The pass-through entity generally does not pay federal income tax at the entity level. Instead, tax item flows through to partners, shareholders, and the beneficiaries. So the entities in which pass-through transactions are there is the partnership, S corporation, trust, and estates. So there are schedules, which is Schedule K1, Form 1065 for the partnership, Schedule K1, which is 1120S for S corporations, trust for Schedule K1 from 1041, and estate Schedule K1 Form 1041. So flow of the capital gain through the pass-through entities is like stock sold by the partnership is being partnership calculate the gain, and they report that gain into Schedule K1. Schedule K1 is issued, and then the partner receives that Schedule K1, and then they have to report that gain in the Schedule D, and then finally that information moves into Form 1040. So Schedule K1 is the starting point. Pass-through gains and the losses are reported on Schedule K1. Information included is like short-term capital gain, long-term capital gain, capital losses, and the other investment income. It has to be passed that information to Schedule K1, which is being used by the taxpayer to put the accurate information into the Schedule D. So Schedule D treatment is that it flows from the Schedule D Part 1. If it is short-term, it moves to the Schedule D Part 2 if it is a long-term. Pass-through entities may allocate the short-term capital losses, long-term capital losses also, and the Schedule D treatment is all this information is reported into the Part 2 as well. So pass-through entities gains or losses are combined with the other profits, investments, other investment gains in the brokerage transaction with mutual funds and cryptocurrency, and it is being reported as net gain or loss in the Schedule 3, Part 3 of the Schedule D. Pass-through reporting is a cornerstone of Schedule D preparation. Taxpayers often focus on the brokerage statements while overlooking the Schedule K1 reporting. Since capital gain and losses retain the original character when flowing through the partnership, as corporation, trust, and estate, proper classification and reporting is essential for the accurate tax compliance and the effective tax plan. So we'll move to the next slide. Now we are going to talk about the most important concept in the capital gain, which is the capital loss limitation rule. So capital losses can provide the valuable tax benefit, but the IRS placed the limitation on how much capital loss can be deducted in a particular year. These rules determine the current year deduction, the future tax saving, and the capital loss carry forward. So if you look at the status, filing status, so single, if it is single, The maximum deduction is 3,000. Merit final joint is 3,000. Merit final separate gain is $1,500, which can be adjusted. So step one, capital loss are first offset against the capital gain for that particular year. If losses exceeds the gains, generally allows reduction against the ordinary income. Capital gain and losses netting process. So step one is that short-term and capital gain, short-term capital gain versus long-term capital losses. Long-term capital gain versus long-term losses. Step three is net short-term gain. So basically, what we have to do, we have short-term gain versus not long-term capital losses. We adjust that. We have long-term gains versus long-term capital losses. We adjust that. And then step three is that net short-term capital gain or the long-term short-term results. Outcome is that either we have the net-term capital gain or net-term capital loss. Capital loss carry forward rules. Unused losses are not lost. Carry forward indefinitely use in the future year and retain the tax character. So we have, for example, we have a net capital loss less of 20,000, and if it is in the same year, then the maximum deduction against the other income can be done to the extent of $3,000, assuming that it is merit filing jointly or single, and then capital gain of 10,000 is there. So what we'll do, carry forward applied remaining carry forward is 7,000. So typically we have 20,000 as the net capital loss. Deductible in that particular is equal to 3,000. This carry forward is 17,000. Year two we have the capital gain of 10,000. So carry forward is 17,000, which was carry forward adjusted in the next year 10,000. Remaining would be carry forward. Short-term capital netting order rules is like step one, short-term capital gain versus short-term capital losses. So first we have to set off the short-term capital gain versus the short-term capital losses. Secondly, what we have to do, long-term capital gain versus the long-term capital losses. First, we have to set within the period itself, like short-term versus short-term, long-term versus long-term. And then once we have the balances available, then cross net remaining the results. And then impact on the form 1040. Capital losses flowed from 8949, Schedule D, and finally to 1040. Possible outcome is that reduce capital gain tax, 3,000 ordinary income deductions, and the future carry forward benefit. So capital loss limitation rules are one of the most important and powerful tax planning provision available to the investor. While losses receive unfavorable economically, properly managed capital losses can reduce the taxes today, and then definitely it has the benefit of carry forward in the future year, which is indefinite future. So we'll move to the next slide. Okay, so now I think we have completely understood the concept of the capital gain, short-term capital gain, long-term capital gain, capital losses, the concept of wash sale transaction, pass-through entities, and then finally we also understood the concept of carry forward of the capital losses and the adjustment system. So let us understand the concept of how form Schedule D is integrated with the other form. Schedule D does not operate independently. It acts as a central reporting point. So capital gain, capital losses, carry forward losses are reporting for the multiple forms, and then it finally flows into the Schedule D. So like for example, investment transaction, it flows to 1099B. It then flows into 8949, then moves to Schedule D. Qualified dividend and capital gain tax worksheet is there. From there it is moved to the Schedule 1, and then from finally into 1040. So taxable capital gain and capital loss reduction and capital loss carry forward. So integration with Form 0199B. So what is Form 0199B? Issued by the broker to the reports sale proceed, cost basis, holding period information, vouchers adjustment. Integration with Form 8949. Form 8949 purpose provides a detailed reporting of the individual transaction, cost basis calculation, and the adjustment. And then finally, it integrates with the Schedule D, Part 2. In this case, depending upon the long term or the short term. Integrated with Schedule D, Part 3, the final summary of the reportable capital gain or the loss. Integration with Schedule 1 for all the pass-through transaction, because all the pass-through transactions are reported via Form K1. Integration with qualified dividend and capital gain worksheet when taxpayers have the long-term capital gain and the qualified dividend. Integration with Schedule 1 in the certain situation, capital loss reduction may impact the Schedule 1 adjustment before finally flowing into the Form 1040. And then all the information is from Schedule D is being reported into Form 1040, which is the final return form. So Schedule D is basically conduit for reporting all the information of the capital gains, short-term, long-term, and it integrates with the 1099B, 8949 form, Form K1, and other information that helps them to, evaluate the entire capital gain, value as well as the taxation. And then final information from Schedule D moves into Form 1040. So with this, we actually cover the entire concept of Schedule D, and we also covered the entire concept of the capital gain. So we'll quickly move to the final slide to understand some of the key takeaways from this chapter. Okay, so I think it's worthwhile that we should also understand this concept through a practical example. So what we did that we have created a practical example here. So we have a John Anderson, a person with filing status single for the tax year 2025, and it has he has reported certain sale proceeds. So say there are certain short-term share transaction which is held less than 1 year. So John accumulated in the shares and incurred the significant losses. So he had the sale of 80,000 versus the cost of 1,20,000. So losses incurred in the short term is $40,000. Plus, but he also has some long-term property which is sold at the profit. So the property was sold at a $6 lakh against the adjusted cost of 575. So he has the long-term capital gain of $25,000. And then he has some ordinary income as well, wherein salary income is there, interest income is there, and dividend income is there. So what we have to do, we have to do the net one. So Schedule D Part 1, net short-term capital loss is $40,000. This will be reported in line 7 of the Schedule D Part 1. Step 2 is calculate the Part 2 of the Schedule D, which is the investment property gain, which is $25,000. And it moves into the line 15, which is the final outcome of long-term capital gain, which is $25,000. Since there is no short-term capital gain, therefore the loss can only be set off against the long-term capital gain. So then the setting off would happen, which is like a cross, which is the short-term capital loss, would be then adjusted to the long-term capital gain. So after adjustment, the net capital loss is $15,000, which is short-term capital loss, net short-term capital loss. Then what we'll do, we'll apply this net short-term capital loss with the ordinary income because the status is filing a single, then therefore 3,000 deduction that is allowed. That will be reduced from the capital loss of 15,000. So impact would be that 3,000 would be reduced from the total taxable income. So total taxable income is 1,58,000 other income, which is salary plus interest plus dividend, and then there's the capital loss reduction of 2,000, which will reduce the total income to 1,55,000. And then step 6 is the carry forward of the losses. So total loss which was reported 15,000. 3,000 got adjusted in that particular year to the other income. Balance 12,000 would be carried forward to the next future years. This is the complete example to showcase that how the carry forward and the adjustments happens. Now we'll move to the final key takeaways. Okay. Now we look at key takeaways slide. So Schedule D is the IRS capital gain reporting schedule. It is used to report the capital gains, losses, capital gains, and the carry forward of the losses. The foundation is that before reporting, taxpayer must determine the asset is a capital asset, and then capital asset has to be either the long term or the short term. Important point is that cost basis should be derived very accurately, and we also need to ensure that Form 8949 should be the form that actually is the foundation of Schedule D. Wash-Shell's rules can disallow the country losses, and then we have the pass-through entities which retain the tax character, such as the capital gain receipt for the partnership as corporation trusts. And then finally, the information flows that Form 1099B information flows to 8949 form, to Schedule D, to capital gain tax worksheet, and finally to Form 1040. So Schedule D is much more than the reporting form. It is the foundation of the investment taxation. Every investment decisions, whether involving stocks, ETF, cryptocurrency, real estate, or partnership interest eventually impacts the Schedule D. So with this, we'll come to the end of this chapter. Let's move to the final concluding slide. Okay, so with this, we have come to the end of this chapter. I think we could able to explain the entire concept of the capital gain and the concept of Schedule D. But we also need to understand the deep dive on the Form 8949, which forms the basis of the information basis which Schedule D is being created. So in next chapter, we'll also talk about Form 8949, which is the detailed form before the information is finally being processed in Schedule D. So with this, thank you everyone for watching this video. Stay tuned. We'll come up with the next chapter very soon. Thank you.